In this video, we will evaluate Eternal's financials and answer questions like why has the founder of Eternal been selling shares? Is the recent development of government-backed ONDC a major threat to Zomato? And is the growing divide between Zomato and its restaurant partners going to become a nationwide phenomenon or just stay limited to states like Tamil Nadu? We will also look at some aspect of Eternal's business that are growing much faster than anyone could have hoped, specifically Blinkit. Could that be the saving grace for this stock? Blinkit's recent rise has often been quoted as the reason behind the rise of Zomato's stock price. Still, as Eternal's share price has risen, its founder has reduced his stake to less than 4%. And he's not alone. Almost all the large investors in this stock have either reduced their investment in Eternal or exited the stock completely. These include Fidelity, Government of Singapore, and BNP Paribas, among other big names. The stock has instead been bought primarily by domestic institutional investors. Now, normally, DII interest in a stock would be a positive sign. However, over the past 2 years, DIIs have been forced to buy stocks even at a high valuation because the rising SIPs put pressure on. So, we cannot assume that just because DIIs are buying Eternal stock, its valuations are justified. And it is truly difficult to justify the valuation of Eternal. Here's how the company's been doing, what to like, and what to worry about. The stock's revenue growth has been very strong, with consolidated revenue at 7,000 crores about, up 70% year on year from 4,200 crores. However, its profits have dropped heavily. For example, in Q1 FY26, the PAT was merely 25 crores, sharply lower versus the earlier periods. Costs, especially from Blinkit's expansions, are eating into margins. While gross profit remains healthy, operating costs, promotional subsidy expenses, rapid growth-related capex, and dark store operating costs are weighing on the EBITDA or the net margins. Blinkit, though growing fast, is deeply unprofitable. Still, the balance sheet is relatively decent, with a low debt to equity of about 6.7% and piles of cash, making sure that the company's existence is not in doubt. However, extremely high expectations are already baked in. The stock is trading above most analyst price estimates of 300 to 330. There is no doubt that this is a brilliant business that has an amazing future ahead, but the primary issue with Eternal as a stock is its valuation. The stock's market cap is 3 lakh crores, higher than all of these companies. And this list includes the likes of Adani Power, Adani Ports, and Adani Enterprises, all of which make more profit than Zomato and all of which are themselves known for being severely overvalued. Look at Titan, which 5 years back was the definition of an overvalued stock. Titan's profits are 12 times the profit of Eternal, but its market cap is still lower than Eternal's stock. And to drive the point home, think about this. Eternal's total sales are less than the profit made by both Adani Power and Adani Ports. Now, if a stock looks this expensive compared to Adani's stocks, we should really be taking that very seriously. Perhaps that is why most of its largest shareholders have decided to exit the company. But most analysts who are bullish on Eternal's stock point to its future. Market research claims that India's food delivery business will grow by a massive 23% over the next 10 years to become 10 times in size. This, coupled with Eternal's aggressive expansion style, should mean constant growth for the company's product. But here, most analysts have made that one fatal mistake. A company's product and the company's business are two separate entities. They are connected in that one depends on the other, but they are not interchangeable. For example, Eternal's stock price is not going to respond only to the product. It is going to respond more to the total sales and total profit, both of which are driven by the commission that Zomato can charge on these orders. And this commission is where Eternal's main problem lies. It is very vulnerable to competition and disruption. Swiggy, for example, entered the instant delivery space in a matter of months once Eternal proved that there was in fact demand for 10-minute deliveries in India. And that highlights a potentially bigger problem. Think about the instant delivery business for a second. When Zomato took over Blinkit for a very high valuation, it risked a large amount of its capital on an unproven business. By the end of this saga, while Eternal took all the risk to find out if quick deliveries could be profitable, Swiggy simply walked into a proven market to scalp profits. So as Eternal constantly takes these big risks to justify its valuation and position as a market leader, Swiggy just has to hold back and wait for one of these big risks to fail. And that is where recent developments have come in, starting with the constant feuds with restaurants. These restaurant owners claim that Zomato charges them exorbitant fees that cut into their margins. Moreover, since people order in more often than they go out to eat, this is really eating into these restaurants' bottom line. And the divide between these supposed partners runs much deeper. You must have heard of a rumor that Zomato runs cloud kitchens whose only purpose is to serve orders from Zomato, even though the CEO has come out to deny it. Operating these cloud kitchens, if Eternal does do that, would be very profitable to Zomato, since they basically cut out all the middlemen connecting the food maker to the clients who still pay the same fees. Because of this profitability, it would naturally be in Zomato's interest to promote these restaurants much more. Now, let me be clear, the CEO of Zomato has denied this practice, calling it unethical, but restaurant owners still claim that the opaqueness of Zomato's advertising policy suggests that the company is trying to hide something. Over and above this, Zomato's commissions on orders are still much higher than what us as users say. You must have seen one of those flyers coming in with your order from Zomato where the restaurant pushes you to order from them directly. The restaurants are forced to do this because even after accounting for the discount they're offering you and the delivery cost which they will have to bear, they still make more money on a direct order than they would ordering from Zomato. Now imagine this, in which industry is it possible for a retailer who is conducting this delivery on its own to price a product better than a wholesaler which would be Eternal that has a network of delivery drivers? All of this came to a boil when an entire city in Tamil Nadu decided to walk away from Zomato after a racist instance. What all of this shows is that Zomato's, and by extension Eternal's current revenue model, is not invulnerable, especially when the government has already been looking at building up ONDC. ONDC, or Open Network for Digital Commerce, is a colossal government initiative that would need a video on itself. But with respect to Zomato, they do two key things. They charge significantly lower commissions to both restaurants and users, and at the same time, they allow users to choose their service provider. Ordering from ONDC basically needs you to have an app like PhonePe and use it exactly like Zomato. Find a restaurant and order. The exact same process, but much cheaper for both you and the restaurant owner. The only reason that ONDC hasn't completely wiped off Eternal is customer loyalty, where people are just so used to Zomato that they don't want to switch. But the unrest with the restaurants could mean that our favorite dinner venue might just quit Zomato for ONDC. If that happens to enough restaurants, people will also be forced to switch. And when this happens, it happens in a flash. We've already seen that with Paytm, where the app has basically disappeared from consumers' phones. All the government has to do is market ONDC widely, and every restaurant would be happy to quit Eternal. With Mr. Modi's popularity, a large consumer base would also move instantly. That is the biggest threat to Eternal's existence. But you may rightly ask, why would the government do that? For two main reasons. First, it is fundamentally good for the people since both the restaurants and the consumers will be paying less. And second, and much more importantly, it will create formal jobs for delivery agents, customer support, and technical staff. The informal manner in which delivery businesses hire their agents is one of the biggest issues for the Indian government right now, and Zomato's stock could be the price India is willing to pay to solve this issue. Still, there is a saving grace. Zomato has found a market that nobody else knew existed. Blinkit as a product seemed illogical and impractical. However, the Indian people have once again surprised the stock market. Blinkit has been a roaring success in its early stages, but even here, cracks are beginning to appear. Where Blinkit had once become operationally profitable, taking Eternal's stock to new all-time highs, recent increase in competition has forced Eternal to invest in aggressive expansion. Basically, Blinkit must reach every city in India before or at least as fast as its competition. This has led to a widening loss margin for Eternal as a whole, which does not bode well for the stock's price. If Eternal's golden child is withering away, what hope does an already crumbling delivery business have?